Thank you for joining us for this discussion around behavioral research and how it can help us to improve financial consumer protection. And we titled this The Secret Ingredient because I really believe, after almost 10 years of working in this area, that the way in which people behave and respond to financial products is one of the most important but underappreciated elements of financial consumer protection. So what we want to do today is to share a bit of why we think this matters, and more importantly, share cases of how behavioral research is improving consumer protection policy. When I say behavioral research, I mean something that is both simple and complex. Simple in that it's a fairly straightforward concept. Behavioral research is about understanding why we make different decisions or take different actions. But the complex part of this is understanding the why requires unpacking different psychologies. So getting inside of the minds of consumers or sales staff. And that itself can be a bit more complicated, which is why we have various different research tools that we can use that borrow from economics, that borrow from psychology and sociology to try and identify, name, and measure these different psychologies or behaviors, and then figure out what can we do to improve policy based on these insights. So from the perspective of the work we do, the most important or useful elements from behavioral science that we've borrowed is, one, inconsistent preferences. I think it's important to remember that we do not always want the same thing every moment of every day. And similarly, that we have inconsistent behaviors. So I may in the evening decide that tomorrow I want to go for a run because I want to get some exercise. But I might stay up too late watching movies on my computer, and then when the morning comes and the alarm clock rings, I hit snooze button because my current self is now tired, and so my past self wanted to exercise, and my current self is now tired because the context is different and skips the exercise. That's what we call intention to action gap, and it translates into things such as people not saving enough for retirement, if we think about a financial services use case. Yeah, another element that is very powerful with behavioral science is we traditionally thought of humans as rational actors, and in the realm of finance, that meant that people were price optimizing. So the financial decisions they made were based on the information they had and taking that information and creating an optimal actual or potential financial return. But there are oftentimes other non-economic factors that impact people. For example, I've done research that shows willingness to repay might depend on the time of day that you send a reminder message. So it's a non-economic factor playing on the context of how someone behaves in the morning versus how they behave in the evening. And then all of this builds towards getting the why of behaviors. And once we figure out why people are behaving a certain way, if we think it's a good behavior or we think it's a problematic behavior, we then have the power to design interventions to either support and confirm behavior and encourage further such behavior, like saving for retirement, or to intervene and steer people away from risky behaviors, such as taking on a high-cost consumer loan without thinking it through first. When we look at financial consumer protection in the light of financial inclusion, I think it's important to remember a few things around behavioral economics and why this matters for financial services for the poor particularly. First, financial products are particularly complex, and when people face complex information, they often freeze and don't take any action or don't make any decisions. Second, we know that trust, especially in areas like digital finance, is key for uptake of these products. And trust is a psychological factor that we can sometimes pull out through behavioral research. Third is that we know marketers are already exploiting these biases sometimes to nefarious effects for financial consumers. So we need to also be armed with the same tools to counteract any potential behavioral biases that are being exploited in the market. And finally, it's not that low-income people make more irrational or suboptimal decisions than wealthier people. It's that the consequences of these common human biases are larger when your income is low and variable, as theirs commonly is. So I want to start by sharing what was, to me, one of the most inspiring cases that really got me interested in working in this field. And this was an experiment done by Marion Bertrand and Adair Morse in the United States with payday loans that you typically you take it out thinking you're only going to use it one time, right? It's an emergency that happens. You don't quite have the money that week to cover health care or children's education or something like that. So you take this high-cost loan, usually you present a pay stub, and then you are supposed to pay it back within 2 weeks usually. So people take these loans out, but then something happens. They end up rolling them over because I thought in 2 weeks I was going to be able to pay it back, but things happen in between, and maybe I do not quite have the money available. So you roll over the loan, and you get into a debt spiral. So the researchers wanted to reduce repeat borrowing of payday loans, so they tested a few different formats with a payday lender, and these are shown on the screen here. And you can see in the upper left, the first idea was maybe we need to use icons to make it clear to people that most people will not pay back their loan without renewing. And in fact, 40% will renew the loan 5 or more times. The second concept, the account in the upper right corner, is maybe people forget to pay. And so they put a calendar on the envelope you receive the loan documents in, and would have people circle the date that it was due and the amount due. Then in the bottom left corner was the third possible solution. They said maybe it's that people don't understand how these costs relate to other common financing tools they have available. So they compared payday loan annual interest rates to car loans, credit cards, subprime mortgages, common loans that this segment would use. Then the fourth intervention, they thought maybe we should make more clear the accumulation of finance charges over time. So they showed how over 2 weeks, up to 3 months, the costs of payday loans increase exponentially, whereas the cost of a credit card, if you paid for that same debt and with a credit card, increase at a much slower rate. And what they found was the most successful was the final option, where they used simple monetary amounts and showed a clear one-to-one comparison with credit cards. So that led to an 11% reduction in repeat borrowing. What's so important about this is, one, that it's presenting information in the way that is most salient to the consumers. Two, that they tested it rigorously. And three, as you can see, this is the power of behavioral research. A very small thing, a new piece of paper, leads to an 11% reduction in repeat borrowing and people entering this debt cycle or debt spiral that happens with payday loans. Another area where I'm excited about behavioral research is financial education. So it's common in a lot of the markets we work in that they'll have financial education programs in schools or perhaps adult ed programs where they're teaching people things like how to calculate interest rate or understand the concept of compounding interest or diversify investments. And they've done analysis of 201 studies on financial literacy, and they've found that generally there is almost no impact on behavior. So teaching someone, what an interest rate is not going to lead to changes in their financial lives. But this is not all bad news, because we're seeing an emerging type of financial education programs that are based on behavioral principles, in particular heuristics. And the heuristics is simple rules, easily understand, and can turn into habits. And so what some researchers have done is started to use heuristics to develop more effective financial capability programs. And one case is in the Dominican Republic where they did 2 different types of trainings for micro-entrepreneurs. One training was standard accounting training around how to calculate profit and loss and how to keep a balance sheet. And the other, they just gave people simple habits or tricks to do, such as write down every transaction in your business, write it on paper. And they found that in the first case, even though they told people to do things like separate their business and their personal income, people did not do that. But in the second case, they didn't tell them separate your business and personal income or keep better accounting records, but people started to do that because they started with a simple task of just writing everything down, and they naturally self-taught themselves, well, from writing everything down, they should start separating it into different categories. So instead of giving someone an overwhelming task of implementing an accounting system from day one, you start with small changes that lead to bigger behavior change. So I want to share 3 little vignettes of work CGAP has done around behavioral research for consumer protection. We've worked in 10 markets so far where we've done technical assistance with policymakers on behavioral research. And I want to share 3 examples of how this is effective. So the first is Peru. And this is a mystery shopping case that was led by Javier Gine at the World Bank based on tools that were developed by himself and CGAP. And mystery shopping is a very common tool used by financial sector supervisors. And in mystery shopping, you are trying to recreate a typical shopping experience, and you're observing what is the quality of the treatment of the customer, what is the information provided, what are the types of products offered. So what we do is we take mystery shopping and we make it behavioral. Use some slight tweaks to typical mystery shopping to tease out more insights on consumer and sales staff behavior. So first, we take a specific segment of population. In the case of Peru, it was lower-income Peruvians because we were interested in their experiences. And the second thing we do is we want to measure, are people given the right service based on their needs as a consumer, because not every consumer is the same. Is there customized financial advice? So we, in one case, with savings shoppers, we have them come in saying they have a certain amount to deposit. In this case, it was approximately the equivalent of $680 US, and that they either want to put the money in an account and leave it in place for a year, or they want to open an account with this money but be able to move money around and manage their day-to-day finances. And then with the loan shoppers, they were requesting a loan either that was 20% or 70% of their actual household income. And remember, we're using real shoppers, so we can use real household income figures. And the other thing that we built into these behavioral mystery shoppings is signaling effects. We want to see, is there any bias towards perceived financial knowledge or perceived willingness to shop around of these consumers. We have them use complex or simple financial terms, have them reference shopping around, or reference this being their first location they've ever visited to see if there's any difference. And a few examples from Peru that we see, when we look at the total cost of a loan, which is the basic rule of disclosure for loan products in Peru, all consumers should be told the total cost of a loan. We see a very significant difference in treatment of those who signal financial experience with those who signal financial inexperience. So we get a sense there's some discriminatory compliance with disclosure rules depending on how sophisticated the customer seems, but the sales staff. We also, when we looked at, okay, the product that the consumer was offered, is it the best value product that could have been offered? So we looked at all of the products that that bank may have available for someone who has that amount of savings or wants that size loan. And we found that, again, signaling experience led to a much higher probability that you were given the best value product of the ones available in that branch. So it's better financial advice. And then similarly, we see that sales staff did a better job of matching the express needs of people who wanted to put money away for a longer period of time to a better value investment account than in the case of those who wanted to move money around and needed savings or current accounts. Finally, we also saw it's not all bad news in terms of how providers respond to different profiles. In the case of those who were requesting a high amount of debt relative to their income, we saw significant reductions in the amount of loan they were offered compared to the amount of loan they requested. So we do see providers doing a good job of measuring affordability or customers' capacity to pay for a loan and adjusting accordingly. Okay, so the next case I want to share is from Kenya around price sensitivity. So in mobile money, we have a transparency problem. Mobile money is a wonderful innovation that has brought a lot of benefits, but we've done a terrible job of sharing how much it actually costs to use this innovation. And these screens are examples from my own personal account. The screen with the black background is me sending money to another person, and the screen with the white background is me paying an electricity bill using M-Pesa. In both cases, you see something missing, the cost. These transactions are not free, but the cost is never disclosed prior to executing the transaction. So in 2014, we identified this problem, and it was around the same time that Safaricom made a change in their M-Pesa tariffs, where they greatly reduced the cost for some low-value transfers. And we noticed something with these transactions in their pricing table. If you send several small amounts, it was sometimes cheaper than doing one transfer of the entire amount. So the example I've highlighted here is if I wanted to send 110 shillings to a friend, it would be cheaper to send 50 shillings and then 60 shillings than to just send the 11 shillings at once. So it's not intuitive that would make sense, but if you knew the pricing tariffs well in the different transfer amounts, you would be able to exploit this. So what we did is we did a survey with consumers to see, one, their pricing awareness, and two, we looked at their transactional records to see, are there any consumers that are price optimizing? What we found was about half the consumers recalled that there had been a tariff change, but very few knew the new tariff rates, and many cited the old rates. So in effect, they were thinking it was more expensive than it was because the provider was not being transparent. But then we also found, even more interestingly, that those users who were more frequent M-Pesa users, a lot of these were people in Kibera, which is an informal settlement in Nairobi, who did M-Pesa transactions on other behalf. Either they transferred money for a relative up country or they paid bills for people. They were much more likely to price optimize, to do these stacked small transactions. So what that told the government in Kenya is that if people are price aware, they will price optimize. So we need to make more people price aware. So what they did is the Competition Authority of Kenya issued an order in 2016 that all digital financial service providers must disclose cost of products and transactions on the mobile handset before execution. And so this was a huge improvement and win for transparency. But the story doesn't stop there. I want to highlight the case of one digital lender in Kenya, Jumo, who had to comply with this rule and did user testing in a lab experiment, which is a controlled environment, to see what is the most effective way to comply with this rule. So they tested things like you're seeing on this screen, different ways of disclosing the cost of various loan options. And this was a lab situation, which is why you see short time periods, because what this was consumers were borrowing money to then participate in activities where they would earn money. So you borrowed money to enter a game where you then would earn actual shillings. And we found that when we separated the finance cost from the principal, consumers did a better job of picking the loan amount that was right for them, and we saw default rates in this lab experiment reduced from 29% to 20%. We also saw that if we made viewing terms and conditions an active choice, we could get higher viewership. And so in the original screens, which you see on the left, view terms and conditions was one of the options on the main menu. And it's the third option. It's the least attractive option. I just want my loan, so I'm going to hit request loan. We said, okay, well, terms and conditions will never be more interesting than getting a loan. So instead, let's put an in-between screen where a consumer can, after they hit request a loan, they have to actively opt out of viewing a summary of the terms and conditions of the loan. This increased viewership by almost 300%, and we see those who read the terms and conditions had lower default rates. So the third case I wanted to highlight is one that's in development. And this, if you remember, I showed that study at the beginning that financial education, traditional school-based financial education, has proven to be not very effective at behavior change. So right now we are working with the Central Bank of Armenia on a project to try and fix this, to put a behavioral twist on financial education. And this work came out of some research that the Central Bank of Armenia conducted with the Alliance for Financial Inclusion, where they did a survey of people who had participated in their financial education programs. And they found there were some positive impacts, but they also found when they measured not just knowledge, skills, or attitude, when they measured behavior, did people change their financial habits, that there were some areas that they felt there were room for improvement. So what we are doing together is a full behavioral redesign of their financial education programs. And this includes 4 stages. These are the stages developed by Grid Impact, which is a behavioral design firm that partners with CGAP on our consumer protection work. And the first is discovery. And this is field research with consumers to understand what are their lives like, what are their financial needs, their financial knowledge, what are the behaviors we see that should be celebrated, or that we should try to shift because they may lead to suboptimal outcomes. Then we work with the Central Bank of Armenia to refine some possible concepts for our behavioral designs. For example, in Armenia, it's very common that people will jar vegetables and fruit during the summer to have food during the scarce winter months. And so this is somewhat analogous or a metaphor for savings, right? Savings is about putting away money when the times are good for when the times are lean. So one of the concepts we came up with was, could we mimic the jarring tradition to help people smooth consumption and reduce scarcity, especially in the winter months? So then you take these concepts and you prototype. And this is a quick testing with consumers to refine what works, even the physical format or the messaging or using the right words or the right delivery channels. And then we do a full experiment where you're doing a robust method like a randomized controlled trial or A/B testing to measure actual impact of the treatments. And so this is an example of how we test the concept in the field. And I think what's important here, you see 4 different types of activities we used in this case, is that in all these cases the consumer is taking a prototype and is looking it over, reacting to it, using it, interacting, and you're seeing what works, what doesn't, where they get confused. So you get insights before your final version is brought live to test. And this prototyping is not just done in a conference room or in someone's home. This is an example, as you'll see. The photo is the Grid Impact Research team put the 6 financial heuristics up on poster board and put a contact number for the Central Bank of Armenia. You'll see those little slips at the bottom of the paper that are the contact number for the Central Bank of Armenia. And they put this at village authority offices, which is kind of the main social area or community area in rural Armenia. And this was done to see, okay, do consumers call? What kind of response do we get? And so you can be creative in how you design and implement these concepts. So we'll be sharing the results of this next year when we do a full impact evaluation test. And these are three examples, but what I want to really leave people with is that we need more of this work. So what CGAP and others are involved in right now is crowding in more policymaker and researcher connections and partnerships. And we're pleased that we've hosted a series of trainings on behavioral research for consumer protection policy. And at the most recent training with Innovations for Poverty Action, they launched a challenge grant where they're going to fund up to 3 RCTs, randomized control trials, of consumer protection policy reforms. And this is a great breakthrough, and we hope that in the next year we can launch additional rounds of training and research. So if you're interested in participating, please reach out to us. Okay, so now we're going to turn to my colleague Stan, who is an actual policymaker who has to take these research lessons and apply them in a real-life setting with all of the economic and political constraints that entails. And he'll talk a bit about how policymakers use behavioral economics.
Thank you, Ray, for the great cases presentation. I think it shows the potential of behavioral research for financial consumer protection. And when I think about the application of these studies into my work as regulator, I think I need to separate my activities here at the central bank in two big groups. One group is providing services directly to the public. And in this category, we can include financial capability programs in which, as you have highlighted in the Armenian case, the use of heuristics can make them more effective with the use of rules of thumb, such as save $1 a day to keep loans away, or don't sign up for a car loan if the installment is more than 15% of your monthly income, which have been proven to be more effective to change consumer behavior than traditional education. But understanding consumer behavior can also help us to find more effective channels to communicate with consumers. So sometimes we think that the technology opens space for new channels such as instant messaging, but for example, in Armenia, we have seen that actually post officers and village authorities are sometimes more effective than sending messages to people. They feel more social about getting this information in one place where they can go and talk to people. But SMS and instant messaging have been piloted to redesign external dispute resolution mechanisms. And we could see that providing tracking numbers and feedback on complaint files help to build consumers' trust in these mechanisms. And consumers started to use them more, and they started to be more effective for the regulator to use this data for supervision and regulation. And the regulator can also use other behavioral tricks actually to improve financial service equality. So, for example, the publication of complaints or complaint rankings have been proven to actually activate peer pressure among the financial service providers. And it was successfully used by the Consumer Financial Protection Bureau in the United States and also here in Brazil by the central bank. But we can think of a second category of activities, and this is about regulating financial services to reduce information asymmetry and correcting market dysfunctionalities. Usually, this translates into rules to standardize market procedures. As Rafe has shown us, disclosure requirements can be more effective with the use of behavioral research. As consumers have limited attention when signing up for products or when transacting with a mobile wallet, for example, price and service conditions um, um, shall, I mean, as consumers have limited attention when signing up for and using mobile wallets, we have to think very carefully on what, when, and how to show price and conditions for these services. And in this way, trying to boost comparability and awareness of consumers. Here in Brazil, for example, credit card invoices are extremely complex because of regulation. So, we central bank and several other regulators require banks and credit card issuers to disclose a number of different credit lines in these credit card invoices, and usually you can see five or six different interest rates and total credit costs. And the result of it is that it's really hard to understand what is the credit line available for you and the cost of it. I have trouble in understanding it. So, can you think how a regular customer that usually is not so familiar with financial services, it's really it can be even misinforming um, to have this number of information shown in a credit card invoice. Another part of standardizing market procedures that can benefit from behavioral research is internal complaint handling. So, the same way that as external dispute resolution mechanisms can benefit from different channels and from um, different ways to reach consumers, internal complaint handling can also be modified and be more effective. But we can also see these techniques being useful for supervision. So I would like to share a case that we had here in Brazil. And back in 2015, we identified a peak in complaints concerning overdraft fees charged by a big private bank. And at first we thought, hey, if people are complaining about overdraft fees, probably it's a problem of disclosure of these fees. And we required this bank to be more salient about these overdraft fees. And when we looked 6 months later at these complaints, we've seen that there were no difference, and people were still complaining about it. And we started to go through the complaints and reading all of them, and we have noticed that in all of them, there was a deposit on the day the fee was charged. But the answer to our questions came up with a complaint from a consumer who explained that he got confused with the balance statement that he had. So what you see in this slide is the balance statement, and you can see that there is a line A, that's the total available, and there is a line A plus B, which is the total amount. And what is in this red square is the deposit that is not cleared yet. So this consumer told us that he got confused and he thought that the amount he had to withdraw from his account was the total amount, but not the total available. And he withdrew the total available and incurred in the overdraft fees. And so we decided to go back to the financial service provider management, and we explained the situation and we require them to be more clearer in the balance statement. And their answer was, we understand that this balance statement is clear. And the argument was between several people in the room and with very high levels of literacy. And of course, everybody there were understanding the difference of the total available and the total amount. But we have to think from the consumer perspective, and that he might not be as literate as us, and he might not have the full attention to the balance statement as we had at that moment. Uh, so this argument lasted for at least 6 months until the financial service provider finally got convinced that he had to change this balance statement. What if we had a methodology to bring the consumer perspective into that meeting? So the behavioral research is the answer for that. And the behavioral research is a four-step methodology. We start with a problem definition, which is the problem that you can see, uh, um, uh, which is the behavior you can see from consumers or from sales staff, and is the behavior that you want to change actually. So in my case, we can say that the problem is that consumers are being charged um, overdraft fees that they don't recognize. And from this problem definition, we proceed to a discovery stage in which we use qualitative research and data analysis to understand this problem. So we can have in-depth interviews, as you have seen that we used in Armenia, but we can also use user experience mapping, which is very interesting because you go step by step what is the way that the user has to go to sign up for a product or to achieve certain outcome. And mapping this experience help us to identify all the decisions that the consumer has to make and help us to identify where the challenges and obstacles might be. So we can act directly where we can see that the consumer might face these challenges. And another way that we can use, another technique that we can use is mystery shopping, of course, to gather data, but also some available data analysis. So in the Brazilian case, we decided to use complaint data. So we went through all the individual complaints and read them to try to understand the problems that consumers were facing. Finally, from the discovery phase, we go to a solution design in which um, we start to together with consumers, we start to concept what would be the way to help them to overcome the obstacles they face in the process. So it will be a joint design solution. And some of the techniques we can use in this is rapid prototyping, where we show a solution and we can quickly change this solution accordingly to the feedback we get from the consumers. And we can also use A/B testing to check what are the preference. So A/B testing, we give consumers two or more choices of a solution, and they tell us which one they prefer to use. And finally, from the solution design, we have to test if the solutions are in fact effective or not. And we can use also several methodologies for that. The most scientific one is the random control trial, in which we select samples of consumers and separate them in two groups. One control group, which stays with the current situation, and a treatment group, which receives the solution that we designed. And we measure which group performed better, so we can check what was the impact of the solution, and if it was high or low, and we can test several types of solutions and actually decides for which one is better. However, random control trials in policymaking, we might face some ethical and political challenges, because you're discriminating people, and you cannot say that you're randomly assigning people a better solution or a worse solution. So you might consider using lab testing for that. The lab test is we simulate a real situation, but as it's a controlled environment and the transactions are not real, we can avoid damages to consumers. And additionally, they are also volunteers to that. So it's easier for us to not face these ethical and political questions that might be raised in a random control trial. Other techniques that we can use is pre-post testing, in which we just compare before the solution being implemented and after it, and field experiments in which we can gradually start implementing a policy, and we can compare all these different the different groups as the policy is being implemented. So it would be a natural experiment. But I would like to share with you also that incorporating behavioral aspects in policymaking can result in two types of policies. So we can see that one type is behaviorally informed. In this case, in addition to the traditional aspects of policy analysis, which would include compliance cost analyses and the consultation with stakeholders, and also an analysis of how this new policy will interact with other policies that are already enacted, we bring the analysis of how consumer and other actors in the market will behave once this policy is enacted. So we can see that this policy might not necessarily correct market conduct issues, and usually these issues will go beyond consumers' choice. One example that we can share with you are the interest caps policies. So one of the questions when we have the interest caps is, are consumers will consumers look for an informal money lender or not if we have this interest cap? So FCA did an interesting study in which they have concluded that payday loan candidates that are not approved for loans, they do not seek for an informal money lender, and this helped them to decide to establish interest caps for this type of product. On the other hand, we have behaviorally designed policies, and these policies use principles of design to help consumer choice. And these principles include nudges and default settings and choice framings, and they aim to solve consumer-facing aspects of market conduct. And one clear example of this type of policy is the key facts statements for loans or for basic transaction accounts, in which we standardize the, the information for better consumer comparability. I believe that now the next question is, well, how do I start doing this research? Should I do this research? Should I outsource this research? Or should I mandate it? And there is no right answer for that. We can see that some some um, some policymakers, they do the research. Others, like the Consumer Financial Protection Bureau in U.S., outsource it. The CFPB actually outsourced the consumer research for standardizing prepaid disclosure um, statements, and this and why they have decided to outsource it, because doing consumer research require a lot of staff and require you to have national representation. So they decided to outsource it because it would be cheaper. But of course, you might require also financial service providers to do some research. So I would like to go back to our behavioral process, and I would like to show to you this matrix in which we think of policymaker led and policymaker overseen um, process. So here we can see that we have all the different phases, and if the policymaker has the full control from the problem definition to the implementation phase, he would be in the extreme left. And I believe that the only way to have the full control of the process are for the services provided by the policymaker to the public. So we can think of the external dispute resolution mechanisms and the financial capability programs here, because we will control from the problem that we want to solve to the implementation of the solution, including the piloting. In the middle here, we have the supervision challenge that we had in Brazil. So we have the problem that we want to solve. We did the discovery of the problem. We identified what was the cause of it, but we did not want to design the solution for that because we did not want to standardize the market. So we required the financial service provider to design the solution and implement it. And on the extreme right, we have the financial service provider product design, in which the policymaker is not involved. So usually it's about marketing, but the policymaker should be overseeing this process. And why we have to oversee it? Because we can see that in many business models and in many product design, the financial service providers embed small behavioral tricks to actually make consumers to sign up for these products, sometimes even if they don't want to. So nudges and default settings should be carefully supervised by the policymaker to avoid the exploitation of the consumer. And finally, in this slide, we have some examples of these interventions from the policymaker-led to the policymaker overseen processes, and some applications of of this research methodology to reach the goal. And now we go back to Rafe for some key messages for the conclusion of this webinar. Thank you.
Thank you, Stan, for that wonderful glimpse into the perspective and the realities of actually turning research into meaningful policy change. I want to conclude this discussion with just a few last messages for the audience. And you see at the top of this slide, I put behavioral research can start small. It just needs to start. And I can tell you from almost a decade of this work, these tools really do work to improve consumer protection policymaking. And we have a wide range of research methods for all budgets and capacities. And we have a growing cohort of talented research firms like Good Impact and academics who policymakers can form partnerships with. So I don't want people to feel intimidated. Behavioral economics, that's such a complex term, or, oh, I could never pull off a randomized control trial. That doesn't matter. There are approaches for all sizes and shapes of policy reform. And whether you are just doing a few focus groups to test how consumers understand a loan contract, for example, or you're doing a full randomized control trial, it is better than doing nothing at all in terms of consumer research and testing. So I just want to encourage everyone to please do not be intimidated and get started. And we have a wide range of tools and talented people here at CGAP and with our partners that can help. So thank you for your time, and we look forward to hearing from you and working with you in the future. And if you would like additional resources, here's a quick list of 4 publications that might be helpful to start on your journey.